All right, how's everybody doing today? We are continuing on with the same old truck. Most of what we did when we talked about the initial setting up the depreciation expense, accumulated depreciation, that deals with what happens every year when you have the truck or you have the equipment. What we are going to do now are the actual sales or retirements of the trucks and how you handle that with your journal entries. And these journal entries are a little bit more complicated. So this is on slide 71. Okay. It's basically the same truck, right? $40,000, salvage residual value, $50,000, 5-year straight line. So the straight line depreciation would be, just to do it one more time, because this is the first time you've seen it, 40,000 minus the 5,000 divided by the 5 useful years life, useful life, and you get 7,000. Okay. Now what they give us is, they give us 4 different scenarios. Okay. And the 4 scenarios are: you sell the truck for $22,000, you sell it for $17,000, you retire it, like you have no use for it, and you don't get another truck or it doesn't work. And one other is you exchange for a new truck, right? Because if you're a company and you get rid of your truck, you're more than likely to get a new truck. But you also have to give a $22,000 down payment. So the first thing we do is, all of these are at the end of 3 years, okay? So the first thing we do is we want to know, what is our book value at the end of 3 years? So our book value at the end of 3 years would be 40,000 minus the 7,000 times 3, which is 21,000. So that we have 19,000. So that 19,000 is sitting on our balance sheet. Okay. Now this first example, okay, and that 21,000 also, it represents an accumulated depreciation. Okay, so we have 21,000 in accumulated depreciation. So if you remember, accumulated depreciation is a contra asset. Okay. So the way it works is the asset, the equipment, it sits as a debit initially. So any of this accumulated depreciation would be a credit, okay? So this would have been sitting there. Well, we want to get rid of it, right? Because in each of these, we're getting rid of the truck. So you can't have depreciation for something that you don't have anymore, okay? So in this first example, right, we sell a truck for $22,000, okay? So what happens when you sell that truck for $22,000? Well, somebody's giving you cash, right? So we know that we're debiting cash. As I just said, I'm just going to abbreviate. We have to get rid of that accumulated depreciation, okay? So we get rid of the accumulated depreciation of 21,000. Okay. If you remember, we also set this truck up on our balance sheet for $40,000 at the beginning. So that equipment has been getting reduced by the contra asset every year, but the equipment is still on our balance sheet, so we have to get rid of it. Okay, because we no longer have the truck. And we get rid of it by what we initially purchased it for. Okay. So the last thing we do, which once we have this set up, and I'm telling you there's only one more journal entry you can figure out, this is 43,000, this is 40,000, right? So we have to balance that off. And that $3,000, I'll just go right into it, it's a gain. Because that $3,000 is a gain because it's sitting on our balance sheet for $19,000, but we sold it for $22,000. So it's a $3,000 gain. Okay, let's get into the next one, which is a loss. So that's the full journal entry. Now, on the next one, right, kind of gave it away. We have 19,000 on our balance sheet, but we sold it for 17 after 3 years. So we have 2,000, okay? So we can start this off as a loss. Now, because A equals L plus E, right, this gain is a credit because that's still on the right side of the balance sheet. And a gain is an increase to the company's value when you look at the balance sheet. So in this example, set up the loss first. So that loss is a debit, right? Because those gains and losses are on the right side, A equals L plus E. And we use a debit in this instance, okay? We got cash, right? Because we sold it for $17,000, okay? For all of these, we have to get rid of the accumulated depreciation, okay? Because we no longer have that truck. So I'm just going to do that here. And then I'm also going to do that here, okay? Because you no longer have the truck, you can no longer have that accumulated depreciation, okay? Now, if you remember, right, similar to here where we don't have the equipment again, we have to credit out that asset. So that we have 17,000, 21 and 2, 23 and 40, and 40 on the equipment, okay? Now, what happens if we retire it after 3 years, okay? Well, if we retire it after 3 years, first we know there's no cash, right? Because nobody's giving us cash. However, right, we don't have the equipment anymore. Equipment's an asset, so we have to credit that out. And in this case, everything is a loss, okay? And they put it underneath, so we'll do that. Okay. And what happens is, just so you remember, before we do the last one, it's a little tricky, right? Remember how you had the income statement and you have revenues, expenses, you have profit, okay? Then oftentimes you'll have something that says other income loss. That's really where these loss and gains would go. Unless, of course, this was like your core business, then it would be most likely up in the revenue and expenses. But in most cases, it would just be other income loss. All right. So the last one is a little tricky. Okay, so it has a few more entries than normal because you're getting rid of the truck. Okay, so we had that accumulated depreciation for $21,000. Okay, you're getting a new truck. That new truck is for $45,000. So we'll just start there. So you're getting a new truck for $45,000. Okay, so that's obviously a debit. You have your accumulated depreciation from the old truck that you got rid of. Okay. Now the old truck was equipment. That also gets removed. Okay. Now, what they also tell you is, and they don't do a good job of it, but they tell you in $22,000 cash, but that $22,000 cash is the down payment for the equipment, for the new truck. So that $22,000 is there, okay? So if you put down $22,000 cash and you get the new truck for $45,000, it's always tricky when these numbers are so similar. What they're telling you is that they gave you $23,000 for your trade-in, okay? So if you remember, okay, when you had that trade-in for $23,000, well, we only had it on our balance sheet at 19, okay? So very similar to the first two, you subtract that value from the 19,000 that's on our balance sheet, and you get 4,000, okay? And in this case, that 4,000 is a gain. So wrapping that up, right? 45 plus 21, that's 66. 62 plus 4 is 66, okay? So this is how, just hold here for a second in case you want to look at or screenshot it. This is how you would handle each of those situations. Whether it was sold for a gain, sold for a loss, retired, or exchanged. And then also the caveat is just this was exchanged for a gain.